Let's discuss or talk about the subject or the concept, or if you will, in accounting jargon, the convention of conservatism. Accountants are known to be conservative people. And I guess you have to be conservative to appreciate what accountants do. So whether that's true or not, I don't know. I once had, I worked at a large international accounting firm in their Philadelphia office at one time, and one of the partners once said to me, "Chuck, you know, you're certainly not the typical accountant." And I took that to be a very high compliment indeed. So, but it's the conservatism that we're known for. The point to conservatism in accounting is that financial statements are to tell a story. And if it's for a year, then it's a story about a year. And the financial statements are to tell you about the company's financial condition, which is what the balance sheet is there for. Is to show you the results of their operations, their profit, which is what the income statement is for. And it's also because usually we're talking about accrual accounting. There's a statement called the Statement of Changes in Cash Flow, which converts the net cash change with the earned profit and loss. So conservatism, we'll tell you what I'm going to do, is I would like to read to you one sentence from this manual that I produced, and this is it. It says, generally this axiom, conservatism, has meant that we should never seek to make an entity's financial condition or results of operations look better than they were. In fact, in my experience, it's almost been that accountants thought you had things, if you overstated profits, that was wrong, but if you understated them, that was okay. But in fact, conservatism in balance means you want these financial statements to be as accurate as they can be within the bounds of materiality and within the bounds of generally accepted accounting principles. So you want them to be as accurate again as you can. To show you how, though, it used to be in the old days, when I took accounting at Penn State as a freshman, the professor was a gentleman named G. Kenneth Nelson. And believe it or not, there is actually a National Hall of Fame for accountants, and G.K. Nelson is in it. But he used to tell us this, and this is a quote, which I've never forgot. Recognize all losses, anticipate no gains. Recognize all losses and anticipate no gains. And for a long time, generally accepted accounting principles would require us to record a liability called a deferred tax liability. But at the same time, generally accepted accounting principles forbid us to record what we now call a deferred tax asset, and is now permissible. So the emphasis has been on conservatism. It still is. It's just that we as an industry have to watch that we don't go too far in terms of being conservative. But what you always want to do, you want to avoid overstating assets, you want to avoid overstating revenues, you want to avoid understating expenses, you want to avoid understating liabilities, but you want the financial statements to tell a true story and an accurate story within the bounds or limits, if you will, of materiality. Thank you.